In this session, we'll be talking of how to use financial statements and budgets as a part of your total personal financial planning. Our focus here is mainly on personal and family planning, family financial planning rather than going for corporate planning. Even principles entailed are basically the same because you as an individual has to behave like a corporate when you're planning your own budgets or when you're planning your own financial life. You're no different. You are in fact put your name, right? I incorporate it. Your name, incorporate it. And then you will be behaving in a different way. If you treat yourself as an individual, normally you think only you are responsible for yourself. When you take up your ownership of yourself as a particular brand or a corporate organization, your behavior changes, your approach changes. So it is important to have a total business approach to your own personal goals. Understand these things as they are very important because basic principle entailed are the same. The reason for financial failures are same for individuals and for organization in most cases. That we'll be talking in detail later on. So understand that you have to use your own financial statements and budget to involve or to create your own growth trajectory, growth in life. So what you'll understand when we are talking of this particular part is, firstly, you'll understand the relationship between the statements and your own financial plans and goals. Secondly, you'll be able to prepare your own personal financial balance sheet. Also, when we talk of personal financial balance sheet, it is very important to have your own income and expenses statement over for a given period. Now, when we talk of a balance sheet, we talk of a particular time as on particular date and time. When we talk of income and expense, we talk of a period. Also, what is very important, you'll develop a record keeping system and understand the ratios and evaluate your own financial goals, and evaluate your own financial performances. That is important. So again, you'll learn to construct cash budgets, and you can use these budgets to monitor your expenses and control spending. Well, what is important is understand the time value of money because that is very important part of your financial goals. Now, when we talk of financial statements, you have two major statements which are very important, and a third one, a performance statement. First is balance sheet as on a given time and date, and also income expenses statement. Well, if you are using computerized tools today, you can have real time outputs. What a great thing, because better tools today, use it better. If you are technologically competent, even if you are just computer savvy, you can use it. And our budgets, they are for future. They detail financial report that looks forward based on expected income and expected expenses. So when we are talking of income and expense statements, we are talking of past time, past 1 year or so. When we are talking of a budget, we are talking of a future time. See, so budgets are basically projections. Now, all these statements are interlocked in a network of financial plans and statements. When we evaluate plan major outlays and expenses, when we manage credit, when we talk of sources of insurance coverage, when we try to establish saving investment programs, when we try to manage employee benefits or employment benefits, when we try to reduce taxes, when we try to implement retirement programs, and also minimize taxes, we are talking in terms of financial plans. Now, these plans, they actually monitor and control our income, living expenses, purchases, and savings on monthly basis. When we talk of monitoring and controlling income and expenses on monthly basis, on weekly basis, on short-term basis, we are talking of budgets. And when we actually assess the results, we are into balance sheet and income and expense statement, which in normal corporate finances, corporate parlances, profit and loss account. So these are financial statements that are important in individual's life, and there is a continuous feedback loop between your financial plans, your budgets, and also financial statements, because they have to move in tandem to be successful, and everything has to be a part of overall financial planning. Okay. Now, when we talk of balance sheet, we are talking of a financial position at a given point of time. That means calculating your total assets, also total liabilities. Now, when we talk of total assets are total liabilities plus your net worth. So, if you want to have your net worth, what is your net worth today as an individual, you have to decrease total liabilities from total assets. So, total assets minus total liabilities will give the net worth. Say, if I have 10 lakh rupees of assets and I have to pay, my total liabilities are about 6 lakhs, I'll be having a net worth of just 4 lakhs, because that is what belongs to me. Okay. Now, the assets which we own normally are, number one, liquid assets held in terms of cash or cash equivalents, something that can be converted into cash immediately. When we talk of investments, we actually are trying to put in money in some financial asset where we can earn some kind of income and also appreciation. When we talk of real property, it is immovable asset. Then when we talk of personal property, we are talking movable and used in everyday life. Now, these are all certain assets that we own. Then liabilities are debts like credit card charges, loans, and mortgages. You can have current and short-term loans due within 1 year of date of balance sheet. You can have open account credit obligations, that certain established credit lines here. We have taken a house loan, you have taken some other loan, or say a car loan which you have to keep on paying. So these are credit obligations, and long-term, that is debt due in 1 year or more from the date of the balance sheet. Now, these are your liabilities. Now, when we talk of net worth, it is actually individual or family's actual wealth. It is your equity, that means actual ownership interest in a specific asset of a group of assets. If your net worth is less than zero, then of course your individual and family is insolvent. That means from your assets you will not be able to meet out your liabilities. It's almost same as we talk of corporate philosophy. Now, what is important is, as your age grows, your net worth should grow, and when you retire, your net worth tends to decrease. So averages move, in a typical kind of a bell-shaped curve that we'll be talking of. I'll show you in a picture, and we'll be talking of later on. So, what is important is prepare your balance sheet format as well as your income and expense format. Now, list all your assets at their fair market value as on the date you are preparing the balance sheet. List all current and long-term liabilities, and then you calculate your net worth. Now, when we're talking of income and expense statement, we are talking of preparing it on the cash basis. That means we are talking of only transactions involving actual cash inflows and actual cash outlays are recorded, number one. Then income that you earn as wages, salaries, bonuses, commissions, interest, dividends, or the proceeds from sales of assets. All this is a part of your inflow. When we're talking of expenses, we are talking of money spent on living, to pay taxes, to purchase assets, or to repay debt. Cash surplus is excess amount of income over expenses that results in the increase in the net worth. And cash deficits are actual amount of expenses over income, and since they result in insufficient fund and decreased net worth. So that means your cash surplus increases your net worth, your cash deficit decreases your net worth. Now, let's understand a typical kind of a health pattern for an urban dweller in India, urban person in India. If we look at it, normally 12 to 13% is spent on food. In some cases, for a middle class I'm talking of, in some cases it might go up to 30%. For creating a house, normally a long-term asset, in a typical metro, we are spending about 30 to 40% on housing. On your apparels and services, it's about 3 to 5%. You see, in most big cities, nearly 15 to 20% is spent on entertainment, on transportation. Just about 5% on entertainment, like your charges for TV, or going out for movies, going out for dinner or something intermittently. These days, healthcare is increasing. People are putting in more in health insurance. So about 6 to 8% goes to healthcare. Personal insurance and pension contributions are about 10 to 11%. Cash contributions are normally 4 to 5%, and other sundry expenses may form about 7 to 9%. So this is typical pattern. Why I am giving it? Please try to develop your own pattern, understand your own pattern of expenses, which is very important to understand. Which is wasteful, how can curtail it, what is necessary, what is important, and what is vital. Going for VD analysis: vital, essential, and desirable. See, vitals cannot be avoided. Essentials have to be met with certain concerns. Avoidables or desirables, a part can be avoided. So to invest further, we have to make this analysis. Okay. Now after this, prepare an income and expense statement. Record your income from all sources for the chosen period. Also establish meaningful expense categories. Subtract total expenses from total income. You get the cash surplus or deficit. Now, certain ratios of financial analysis which are important for you to understand are: number one, solvency ratio. Okay. That means what is your total net worth divided by your total assets. So if you have total assets of say 1,000 rupees and your total net worth of 25 or 250, then your solvency ratio is about 20%, 25%. Similarly, liquidity ratio is the ratio between total liquid assets divided by total current liabilities. Okay. That means liabilities that have to be met within certain period of time of maybe maximum 1 year. Then savings ratio is your cash surplus and divided by the income after taxes. Okay. How much you save, because after all, saving ratio is going to decide your investment ratios as well. And then debt service ratio, that is how much your total monthly payment against debt divided by a monthly total income after tax. So normally it should not exceed 30 to 40%. Best is around 20% in young age. Later age, even 20% is on the higher side. So when we talk of cash budget, it takes into account estimated monthly cash receipts and cash expenses for the coming year, because it helps you to maintain necessary information and to monitor and control your expenses. Okay. Also, cash budgets allow you to decide in how to allocate income to reach financial goals. Then it also creates a curve for disciplined spending. It is important to reduce needless spending, and when you stop needless spending, it also helps you in achieving your long-term financial goals. So 3 stages: estimate income, estimate expenses, and finalize the cash budget. Now when you have temporary budget deficit, how do you deal with it? Shift expenses from months with budget deficits to months with surpluses. You can even out expenses over the years, and then use savings, investment, or borrowing to cover temporary deficits, depending on the situation as it is. When we're talking of dealing with annual budget deficits, you have to normally liquidate your saving or investment, or to borrow to meet the total deficit. Now here's the catch, where you have to make certain efforts. You can, because now the situation is clear before you, you can cut low priority expenses from the budget, or make additional efforts to increase income. You can do more work, you can do part-time work, extra work, you can work from your home. These days, a lot of avenues are available for you to work on your computer from your home itself. So after this, you can prepare a control schedule where you can talk in terms of budget categories and what are the variances from those budget categories. Can you really understand where the slippage is? If there is a slippage, there is something extra that you spend, you can cut down on that. Uh, Now, when we talk of time value for money, just understand that a rupee today is worth more than a rupee received in future. So, like, say if I have 1 rupee with me and I am earning 10% rate of interest in 1 year, so my future value of this money would be 1 rupee 10 paisa. Okay. Or my 10 rupees would be equal to 11 rupees. Now, this is what we call as compounding. That means when we talk of future value, we talk of amount invested plus future value factor, that is 1.1 here. Okay. Again, when we talk of annuity, is a fixed sum of money that occurs annually. That is, yearly savings is amount of money desired divided by future value of annuity factor. Now, present values are actually achieved by discounting the future value of money to present value. So, if I put future value and divide it by present value factor, I'll get the present value. Like if 11 rupees today, tomorrow, that is after 1 year, if I divide by 1.1, I'll have 10 rupees today. So, a present value in terms of future values is lesser because it is to be discounted. Okay, so that's how we understand. So if there is a 10% of return, I'll be neutral in terms of having 10 rupees today and 11 rupees tomorrow. However, if I am having less than 11 rupees tomorrow, I'll be preferring 10 rupees today. That is your time preference of money. Okay, and based on this, you can prepone and postpone decisions. Okay, so the key terms that we talked in this particular session personal financial statements like balance sheet, income and expenses statement, then budgets, liquid assets, we talked of real property, we talked of personal property, we talked of fair market value, we talked of current and short-term liabilities. We talked of long-term liabilities, we talked of net worth, we talked of equity, we talked of insolvency ratios, we talked of cash basis, we talked of present value of money, we talked of liquidity ratio, we talked of saving ratio, we talked of debt equity ratio, we talked of discounting, compounding in present values and time value of money. We also talked of budgetary controls. So these are important. So just understand that financial plans, financial statements and budgets, they provide direction for you to work towards specific goals. Balance sheet preparations enables you to know your financial status. Income and expense statement is prepared on cash basis and actually records the cash inflow and cash outflow. And all this together helps you in preparing, analyzing and monitoring your personal budget. And these are essential steps in successful personal financial planning. So get a diary or open an Excel sheet in your on your computer, on your personal computer, on your PC, on your laptop, and start recording everything, start preparing your financial statements. That is going to be a great vehicle for you for planning your future. See, what we are going to talk here mostly are the concepts, percepts, tools and techniques. Now, these financial statements are our tools to achieve financial plans for future. Again, when we talk of plans, write down. Plans are always written. Written statements you can see. When you pen down something, when you see something written somewhere or recorded somewhere, the impact is higher than just trying to remember it through your mind. Thank you very much. Close here.